Did you know that someone who invests $10,000 per year from age 25 to 35 will have more money at age 65 than someone who invests the same amount every year from age 35 to 65? That's the power of compound interest. But I get it. Starting to invest can seem intimidating, especially if you're a beginner. That's why I'm here to break it down for you. In this video, I'm going to share 10 essential investing tips that every beginner needs to know. These tips will give you a solid foundation and set you on the right path to building wealth. So, grab a notebook and let's get started on your investing journey. Before you even think about buying your first stock, bond, or rental property, you need to define what you're actually working towards. What do you want your money to do for you? Are you saving for a down payment on a house, early retirement, your dream car? Having clear goals will not only motivate you to save and invest more, but it'll also help you determine how much risk you're comfortable taking. For example, if you're saving for a down payment on a house 5 years from now, you're not going to want to invest your money in high-growth, high-risk stocks. So before you do anything else, sit down and write down your financial goals. Revisit these goals regularly to track your progress and make adjustments as needed. Risk tolerance refers to your ability to handle fluctuations in the value of your investments. Some people are completely comfortable watching their portfolio drop 20% in a year, while others lose sleep over a 5% dip. The key is to find the right balance for you. Don't invest in something just because someone else is making a lot of money from it, especially if it keeps you up at night. A good way to determine your risk tolerance is to ask yourself how much money you're comfortable losing in the short term. Younger investors with a longer time horizon can typically afford to take on more risk because they have more time to recover from any potential losses. On the other hand, older investors who are closer to retirement may prefer to invest in more conservative investments. Understanding your risk tolerance is crucial for making informed investment decisions that align with your financial goals and comfort level. There are a lot of different ways to invest your money, and it's easy to get overwhelmed by all the options. The good news is, you don't need to be an expert in everything. Start by understanding the basics. Some of the most common types of investments include stocks, represent ownership in a company; bonds, essentially loans that you make to a government or corporation; mutual funds, allow you to invest in a basket of stocks, bonds, or other assets. This is a great way to diversify your portfolio and reduce your risk. Real estate can provide both income and appreciation. You can invest in rental properties, REITs, or even crowdfunding platforms. Each type of investment has its own risks and rewards, so it's important to do your research and choose investments that align with your financial goals and risk tolerance. Let's talk about why it's so beneficial to start investing as early as possible. Imagine a snowball rolling down a hill. As it rolls, it picks up more snow, getting bigger and bigger. That's compound interest in action. The earlier you start investing, the more time your money has to grow. Even if you can only invest a small amount each month, it will add up over time, especially if you're earning interest on your interest. Let's look at an example. Investor A starts investing $100 per month at age 25 and earns an average annual return of 7%. By age 65, they will have over $232,000. Investor B starts investing $100 per month at age 35 and earns the same average return. By age 65, they will have about $101,000. You've probably heard the saying, "Don't put all your eggs in one basket." Well, the same applies to investing. Diversification means spreading your money across a variety of different investments. Why is this important? Because it helps to reduce your overall risk. If one investment does poorly, it won't have as big of an impact on your entire portfolio. Think of it like this. If you invest all of your money in a single stock and that company goes bankrupt, you could lose everything. However, if you invest in a diversified portfolio of stocks, bonds, and real estate, even if one investment does poorly, the others can help to cushion the blow. You can invest in different asset classes, such as stocks, bonds, and real estate. You can also invest in different sectors, such as technology, healthcare, and energy. And you can invest in different geographical regions, such as the United States, Europe, and Asia. A lot of people think that investing is only for those with a lot of money. But the truth is, you don't need to be rich to start investing. The key is to make investing a part of your budget, no matter how big or small your income. Think of it like this. You wouldn't wait until you had a ton of money saved up to start paying your rent or mortgage, right? Investing should be treated the same way. It's an essential part of managing your finances and building wealth over time. Start by tracking your income and expenses to see where your money is going. Once you have a good understanding of your cash flow, you can start to allocate a portion of your income towards investing. One of the biggest mistakes that new investors make is trying to time the market. They wait for the perfect moment to buy or sell, hoping to buy low and sell high. But here's the thing. No one can predict the market with 100% accuracy. That's where dollar cost averaging comes in. Dollar cost averaging is a simple investment strategy that involves investing a fixed amount of money at regular intervals, regardless of the price of the asset. By investing consistently, you're buying more shares when the price is low and fewer shares when the price is high. Investing can be an emotional roller coaster. 1 minute, the market is up and you're feeling like a genius. The next minute, the market is down and you're ready to sell everything. But here's the thing. Emotional decisions are rarely good decisions, especially when it comes to investing. When you let your emotions dictate your investment decisions, you're more likely to make impulsive buys and sells, which can lead to costly mistakes. That's why it's so important to have a plan and stick to it, even when the market gets tough. Remember why you're investing in the first place, and don't let short-term market fluctuations derail your long-term goals. When the market is down, it can be tempting to sell everything and cut your losses. Your investment strategy should not be static. As your life changes, so too should your investment plan. For example, if you get a raise or bonus, you may want to increase the amount you're investing each month. Or, if you're getting closer to retirement, you may want to shift your portfolio towards more conservative investments. It's important to review your investment strategy at least once a year, or more frequently if your financial situation or goals change. If needed, rebalance your portfolio to ensure that it's still aligned with your overall investment strategy. You don't need to be an expert in everything to be a successful investor. Sometimes, it's helpful to seek professional advice from a financial advisor. A financial advisor can help you with a variety of tasks, such as creating a personalized financial plan, choosing the right investments for your goals, managing your portfolio, and tax planning. If you're not sure whether you need a financial advisor, ask yourself if you have the time and knowledge to manage your investments on your own. So there you have it. 10 essential investing tips that every beginner needs to know. Remember, investing doesn't have to be complicated. By setting clear financial goals, understanding your risk tolerance, and following a disciplined investment strategy, you can achieve your financial dreams. If you found this video helpful, be sure to give it a thumbs up and subscribe to my channel for more videos on personal finance and investing. And be sure to let me know in the comments section below what you're currently investing in or if you have any questions about getting started.